So my name is Zacc Call. We have Kurt Brown with Townsquare Capital. Townsquare Capital is an Orion company now. Orion has purchased Townsquare. Kurt's still heavily involved to give you guys an update on that. Townsquare has done some amazing things within the space of building investment portfolios, structuring them in a way that makes them more efficient, lower cost, and advisors are excited about that. Clients have been excited about that, and their performance has been solid. And so, of course, Orion took notice of that and knocked on the door and said, hey, what are you doing over there? Let's talk about it. And so they want Townsquare to help continue to expand and make that offering better and better. And we hope to see some good things out of it. Orion is really a big tech giant, and they're throwing a lot of technology resources at what Townsquare, I would say what Townsquare has mastered is two things, which is like maybe three things, sorry. The structure, the people, and then they have mastered the trading aspect of it. So like the structure, I mean like how you guys get your investments, how you folks get investments. They found a way to do it where they're giving the investments that usually were only available, the structure that was only available for really, really high net worth people, 10, 50, $100 million. And we're able to execute that in accounts of a lot lower balances than most people have. Okay. So that's that structure. And then the people is Kurt Brown's team and their investment team to help analyze and triage portfolio managers and find the best managers that are usually low turnover, semi-concentrated, and high quality. Okay, so that's the philosophy that they've taken. And then the third thing is the trading aspect. So I visit the trade desk up in Idaho Falls regularly, and we talk about how they implement trades. And it's amazing. The process that they have, just know that the accounts are reviewed individually and traded individually. And they may know that they've got a bunch of accounts that all need one trade, but they review each account before they push the button to trade 100 accounts at once, for example. And oftentimes your accounts get traded very individually. And not even that, sometimes a portion of your account gets traded individually, not even just your whole account. So anyway, gives you a little bit of insight into what's going on there. And we think that some of the technology that Orion has will help enhance a lot of that. Okay. So and
for those of you that have taxable accounts, the way that the trade desk trades is much more tax friendly than most firms. And that was a really important thing when we built the firm. And that's to Zacc's point, why I give you an example. Our firm of the $7 billion that we directly manage for people like Capita, we have 13 traders. The firm, the average in the industry is about a quarter of that. So we put a lot of people in trading to help tax optimize accounts too. Probably totally boring, Zacc, for everybody on this call, but that's an important part of what is attractive about the business.
Yeah, makes sense. Okay, so I'm Zacc Call. I'm president of Capita Financial Network. Mike is the CEO. Cassie is the chief operating officer. Hope sometimes people are confused by that. I was confused by that. CEO, and then Cassie and I work together to execute on everything. And then you guys all have advisors and relationship managers and team here. Let me dive into my question here, and I'll explain. First of all, I want you guys, Tyson Long, one of our advisors, sent this over. He'll be embarrassed that I'm having us watch this, but take a look at this. This is the S&P 500 stocks in 2022. And Kurt, maybe you can confirm that this is coming through. You see a bunch of bubbles on the screen?
Yeah.
Okay. So each different color represents a different sector of the market. I actually love looking at the market by sector because it tells you a lot about what's happening overall in the marketplace. So I'm going to hit play, and this is going to go, they only did this up through September, but this gives you January through September of last year. Watch what happens to the different sectors, like purple up there in the middle, that's energy. That big green is technology. The size of the circle represents how big that stock is compared to the rest of the stocks in the S&P 500. But just look at how much energy has just performed so well compared, and utilities. And then communication services, consumer cyclical, technology have underperformed. The dotted line represents the S&P 500 on average. Here we are in July. And then this dark solid line across represents a 0% return. So hopefully that, I just found that fascinating. It's kind of almost satisfying to just look at, not because it's down, that's frustrating, but the image is really interesting to see how things ended out or how things progressed throughout the year. Okay, that was more just like interesting. Take a look at that. Here's my question. So another one of our advisors, Tim Gottfredson, sent this over. This is a Bloomberg compilation of Wall Street's expectations for 2023. And I loved this article. It's very fascinating. And of course, being like a data and organization type person, I loved that they did it this way. So you could say, tell me what their opinions are about the dollar and in particular assets or different institutions. And you get just the quick take from each institution on that topic. So I went to all themes. And if you go through these, and we're not going to read a bunch of them, but if you read through these, so many of them, look at this. I mean, continues to reflect an overall cautious stance. And markets have become too complacent. And I mean, there's just across the board, the US will enter recessionary conditions. Now, there were some that had a bullish outlook, good news here. But it seemed like the overall, like if you were to just check a bar or put a tally mark on one side or the other of bearish or bullish, it was definitely a lot more bearish. But then I got this other, hold on just a second, let me find it. I got too many windows up, right? All right, so this is also from another company that's giving us some of the top money managers target for the S&P 500 for 2023. So here we go. Fundstrat says that it'll be about 4750, which is an implied 23.7% positive rate of return. JP Morgan, 9.4. I'm really interested, like, what is JP Morgan saying in here, right? Because here we have JP Morgan giving some pretty concerning verbiage, but yet some pretty optimistic numbers. So like, what is the disconnect here, Kurt? Why are these people always like this? This is so frustrating.
Oh, Zacc. Zacc. This is why I love Zacc. Zacc,
I press?
No, because you're not supposed to ask this question. This is why I love you. You're not supposed to ask that question in front of your clients because this is what Wall Street does. Okay, so let me react on a couple things here. One is, it depends on, okay.
I'm going to stop sharing, by the way, because I have a feeling you're going to want to put things up there.
Yeah. You almost can't even get me started on this because this is the world that I come from. Most of you know I'm a recovering Wall Streeter. I was in an investment bank for a lot of years early in my career. I can't stand the way the investment banking community runs and works. It's just wrought with conflicts of interest. Here's the problem. Depending on the division at JP Morgan that you ask, you're going to get a different answer. You can actually see 3 headlines in one day that says, JP Morgan says stocks are going to crash. Stocks are going to be up 20% next year. Stocks are going to be neutral. And it's 3 different divisions inside of JP Morgan and 3 different economists or market strategists are going to do that. Okay, so that's one thing. You got to understand these banks are massive. They don't have one party line. Number 2, when Wall Street speaks, this is going to sound weird. There's a weird thing amongst academics, Zacc, that if you're smart, you're negative.
That is so true. That is 100% true.
Go to any college campus in this country. If you walk around and walk into classrooms, they're going to sound pessimistic and derogatory and negative and put everybody down because that's what academics do. And the smarter you are, the more bearish you are in finance. Like
I haven't seen it anywhere other than finance, but I definitely have seen there are a lot more pessimistic financial experts.
Pay attention to what I'm talking. Like, you'll see hedge fund managers come on CNBC and the world is ending, but then you look in their portfolio and they're 80% long and 20% short. Like, how is the world ending and you're 80% long? Okay.
Especially for those who are listening, a hedge fund has the freedom to do whatever they think is or necessary or needed. So they don't have a mandate where they have to stay fully invested. So that they're supposed to invest 100% on conviction. So if that's their conviction, why does their portfolio not represent their words is basically my question. And I don't know if there's an answer, but I mostly want to ask it because one, if you have some insight, great. But two, clients and other listeners recognize that this is also a big driver of fear. And
yeah. Oh yeah.
so what happens is you not the news does this too, right? But even the portfolio managers are hesitant to be overly optimistic and then wrong, right?
Yep.
It's almost better for them to be pessimistic and then wrong and have it be a little better than what they thought.
It's no secret in the media that in fact, I can show you the data. We've got great white papers on this. You as a viewer will click on news articles that are negative much more than you'll click on positive articles. So what happens is if I scare you right now on today's call, there's actually a greater probability you'll listen to me because what I've done is I've pressed on your fear. And so then you think I must know something other people don't know. There's really interesting.
Why do the managers do that? You do, I don't know. Anyway, it just seems weird to me.
But newsletters on Wall Street that cost money, if you subscribe to a newsletter, 80% of them are bearish all the time.
Yeah.
Year round, 24/7. How can you be bearish for 30 years when the market goes up 11% a year? That's not why they're bearish. They're bearish to get you to listen to them.
Yeah, which by the way, somebody asked if that Bloomberg is behind a paywall, and I responded, but it is. So there you go. I had to pay to be able to get access to that.
All right, here's a third reason. If I tell you why something is happening, I sound smarter. Okay, so here's what I want you to do. We get off the call today, turn on CNBC, and count the number of people that will tell you why the market was up or down today. And you and I know the real answer. There was either more buyers than sellers or more sellers than buyers. That's the actual answer to why the market was up or down today. There's nothing else. In the short run, markets are nuts. It's right. But they want you to think, oh, you're so smart. You can assign why something did what it did today, right? So Wall Street, that's why Zacc, you and I have worked for how many years together? I will never ever give a market prognostication for the year because a great portfolio of investments is built to weather the occasional awful period of time. And you're not going to time it anyway. So these guys, they crack me up. They just want you to think that they're really smart because they're almost never right. Let me give you one stat. If you go back to the Great Depression, the market averages about 10% a year return since the Great Depression, 8 to 10% net after taxes and fees. Okay. But how many years is the market up 8 to 10%?
It's hardly ever. Since
1950, only 4 years.
Yeah.
Okay, but all of your newsletter writers, you showed that graphic. How many of them are in the 8 to 12% range? They'll all cluster in there with a few outliers because it's the safe place to guess what the market's going to do this year. And these guys are idiots. They're clueless. They have no idea. I mean, but that doesn't mean you can't be a great investor, right? The way you buy assets makes you a great investor. Not that I know what the S&P is doing this month,
Yeah, because you can buy quality assets that are going to go down when markets go down, but you can feel comfortable with them because you trust that they'll be around after things settle.
Yeah. It drives me crazy. You're asking the question you're not supposed to ask.
Well, I don't know. I don't know those things. I don't know what you're not supposed to ask. But yeah, let's dive into it. So if you want to take and show us anything, I mean, it'd be interesting to know maybe top 1 or 2 or 3 topics right now that you feel like are the most important for our investors to know, keeping in mind, of course, that we have an age range of, some people in their 30s and 40s, but it probably clusters more around 50 to 70.
That's right.
And we have folks of all different asset ranges, and everybody's trying to figure out how secure is their retirement plan.
Let's do this. I'm going to move quick.
Go for it.
Anybody that wants these slides can have them. Zacc will send them out. His team will send them out. It's totally fine.
And this recording will be available as well. So if you feel like you want to rewatch it or something like that, that's fine. But we'll send out an email with all of that.
Okay, let's talk about what's relevant. So here's the bottom line. Fed printed all the money. We gave it away. We didn't even ask businesses to pay us back, right? They give away PPP. We overinflated the economy after COVID. We got too hot. Things got too good. That's what inflation is. Okay, now Fed starts raising rates, aggressively starts raising rates to get inflation calm. Okay, the economy was too hot. Okay, now here's the question. Is it working too good? Is the Fed's efforts to slow inflation down actually going to push our economy now into a recession? And that is the question of the hour. So let's go through a couple of these things real quick. How much is inflation slowing down? I'm just going to blast through a few of these charts. Manufacturing orders, 40-year low. Durable goods orders, 40-year low. There's right there, imports of goods. How much are these container ships coming into the United States carrying goods on them? Trinkets, widgets, things like that, plummeting quickly. Went way up coming out of COVID and really dropping off a cliff right now. That's important. We needed this for inflation to slow down. Now, businesses went from owning no inventory out of COVID to too much inventory, a record amount of inventory. Businesses that sell widgets, they own a ton of stuff. If you went shopping at Christmas, you know what I'm talking about. I go down to Walmart. I want to buy a toy for my nephew. It's 3 days before Christmas and the shelves are packed with toys. You never see that 3 days before Christmas. Plenty of inventory, right? Look at this. Shipping rates from China to the United States down over 90%. Client of mine runs a big logistics business at Long Beach Port. There was a point during the financial crisis, they had 120 ships trying to get into the port. I said financial crisis. I meant post-COVID, during the COVID crisis, trying to get into the port. Right now, zero. Anybody that wants to dock at Long Beach Port has a place to come and dock, right? So the supply chain mostly completely repaired now. Used car prices coming in really quickly. They exploded coming out of COVID because we didn't have any cars to sell. Now it's the other way around, right? How about gas? We all were worried about gasoline last summer. Gasoline ended 2022 down on the year for gas prices, right? How about lumber? Do you know that lumber traded where it is today 18 years ago for the first time at $400? Okay. It's all done. We gave all that lumber back. The lumber market is completely normal again. For those of you that built a house 18 months ago, I'm really sorry. You are really mad now. I know that.
Yep.
Okay. Nat gas in Europe. 4 months ago, we were worried that all the Europeans were going to cut up their dressers and burn them just to stay alive. There is so much natural gas in the system that natural gas prices are making a 2-year low in Europe. Okay, that's great. The inflation was murdering everybody. It's coming the other direction now. That's great news. I'm not showing wheat here. Wheat prices are doing the same thing. We were all worried because a third of the world's wheat comes out of Ukraine and Russia. No problem on wheat prices globally. New and existing home sales, second lowest reading ever for existing home sales. So overnight, mortgage rates go from 3 to 6.5. And then let me show you what else. There's a record amount of homes under construction in the US. That's what you're looking at here. All-time high. We've never had so many homes right at the same moment being built. This is this is multifamily. So this is apartment complexes, condos, townhomes. Also, brand new all-time high number of multifamily units under construction. So you do the math. Lots of supply coming online, mortgage rates doubling, people's stock portfolios going down 15, 20, 25%. There's your recipe, right? So you're going to get an easing in home prices, and we're seeing it in the hottest markets already. Austin, Texas down 15%, Sacramento, Boise, places like that, right?
Hey, so tell me about, question on this, because I mean, it seems like it's always funny when in my social network, I hear about things. Everybody's complaining about the price of eggs and cheese. And it's still, so we're experiencing a decent amount of that inflation coming back down and supply coming up. You would expect the prices of some of those things, but it feels like food in particular has not followed suit. Is it just the lag?
There it is. You were one slide ahead of me.
Sorry.
You're so good. You were just one slide ahead. So look at the right. Okay, the leading indicator in food is always fertilizer. So when you call farmers, like you want to know where food's going, call the farmers, find out what the fertilizer's doing, right? Like bulk rate fertilizer is crashing through the floor. We're going to get easing in food prices. Here's the comparison though, Zach. My brother is a senior executive at Manheim, the largest auto auction in the United States. Here's what's happening. A year ago, all of his biggest car dealers in LA, they had no inventory on their lots for used cars. Okay, now bloated. They're parking cars down the street, but prices are down 14%. They should be down 30%. And he tells me the same thing. He says all the dealers are doing the same thing. They don't want to break price yet. They're all hoping that the economy is still good enough that it'll work through. Probably not going to happen. Food is doing the same thing. All the grocers are hoping they don't have to break price because they're minting money right now. They're in the sweet spot of the curve where they can buy a little cheaper and still sell really expensive.
It feels like the builders have done that with lumber, at least over the last year or so.
Yeah.
Maybe it's finally coming back to where builders have been reducing prices. I don't know, because I haven't been in that market as much, but it seems like they've been able to maintain their overall bid at a similar amount. Their cost on lumber has dropped, and they're just keeping that spread.
It's a real human behavior thing. When you study recessions, let me give you another one. The front part of a recession always looks the same. The average American won't reduce their spending at first. They'll use their savings first. It's an odd human behavior. We get used to living in a certain way. We don't want to change it. It's the same when you run a business. You don't want to lower prices yet. You just want to hope it gets right. And then bang, everybody does it at the same time. So we're probably going to see more reductions in inflation, or what we call deflation. We're probably going to see more deflation coming in the system here. Look at this. If you look at inflation over 1 year, it still looks high. It still looks like it's 5 or 6%, but it's not. Since June, the inflation picture is completely different. In fact, since June, inflation is back to 2.5%. We're right back to what we were for years and years and years, but that's the 6-month number or the 5-month number, right? So that we're in that window, Zach. And a lot of us think that the Federal Reserve has probably already raised rates too much, that actually the economy is actually slowing more than everybody would have hoped. And by the way, here's where people put their money where their mouth is on this. So this is what we call the Fed funds futures market. It's what big investors in interest rates and bonds think is going to happen. So
and
what they all
just think, right? This is like literally what they're paying for, right? Because for those people who may not understand the word futures when it comes to investing, is typically an agreement that you will transact at a future date under the certain conditions. So when we say a futures reading like this, what that basically is saying that the public is, or the participants are not only saying they think rates will be this, they're saying they're buying in anticipation. They're entering a contract to guarantee themselves that rates will be that price in the future.
Great point.
Which is different.
Actual contracts being bought right here.
Yeah, which is very different when it comes to behavior and investing. What people say and what people do are, and that's, I guess, in many aspects of life. But when it comes to investing, where people are willing to put the actual dollars is very telling.
So what you have here is that the interest rate community of bond traders, big bond traders at banks and wherever, they're saying that interest rates are going to peak in May, but then 18 months later, the Federal Reserve will have lowered interest rates by a full 1.5. So the market is basically saying, look, we're almost near the end of this cycle of raising rates. And the Fed is going to have to stimulate the economy again and start lowering. So that's why the new area of focus, Zach, is not on inflation. It's on, are we going to slow down too much? Are we going to slow the economy too much?
So a question that is here, it's actually, we'll try to hit some of this. And Steve, I just love your commentary, by the way, in the Q&A. Probably won't hit every one of them, but I will respond typing back to you. Kevin's question. So it's a really good point he's bringing up here. It seems to me that this inflationary period could have been avoided if the government would not have spent so frivolously. Is that a correct assessment? And I mean, it feels kind of like it's a very complex system they're trying to anticipate, right? But it feels kind of like, I hope I don't offend, but and somebody who's driving under the influence a little bit here, right? You know what I mean? We corrected too far this way, too far that way. But it's hard because there are no lines on the road for them to read either. And what is he right?
Oh, he's so right. I mean, Kevin is just talking sense. And the problem is the government's not talking. Kevin, that is 100% correct. I mean, and by the way, thousands of sophisticated investors were telling the Federal Reserve this for 6 quarters. Like, look, wait a minute. You are way overstimulating. Like, we gave away trillions in PPP. And then at the end of the program, we said, don't pay us back. What the hell is that? These are the people that didn't even need the money. What did you think it was going to do to inflation? I mean, Kevin is spot on the money. We just,
but I mean, at the same time, I mean, we all have our own feelings about politics and how biases play into it. But there are some smart people trying to figure this out. I mean, you've got some decent economists trying to anticipate. It's a pretty complex system.
But the politics play too much into it now. When the Fed was started, it was supposed to be totally independent. And that is not, look, the other problem is almost all politicians, no matter what their party is, they want to buy votes. We don't really have a regime interested in not spending money. So we're in this problem now of everybody just wants to spend. So inflation's becoming like more of a problem. Nobody wants to stand up and be the adult at the table and say we can't, we can't spend anymore. Like, nobody wants to do that.
Okay, let's answer this one about shipping. So basically, shipping from China is down over 90%. How does that affect the US? And how does that affect China? So I'm assuming we're talking about leading economic indicators, how we're not buying as much. How does that affect our relationship there and both markets?
Well, that's a great question. In this specific case, we're really just talking about the normalization of a dysfunction. We were having a real supply chain problem.
That's true.
Right? So there actually, believe it or not, is not going to be that much of an impact to GDP on either side. You were just robbing Peter to pay Paul. Kind of a non-issue, and really, honestly, something we're really grateful we got re-rated here, right? And for a temporary time, shipping companies made a ton of money. And, like, for a temporary time, certain market participants just minted money. But that's all being worked out. The market's getting back to being efficient. Doesn't really actually even affect China or the US. It's just that some people got to pick the market off.
I see.
Right?
Okay, last question that's in there. I don't have an answer for this one, but why is diesel so much higher than gasoline? Do you know the difference?
This is a refining problem. I mean, one of the things that you see in fuel everywhere, with any part of the crude or fuel food chain, is depending on can you refine it and can you move it? And everything plays into that. And we have these periods in both US and European history where that gets dislodged. And so what happens is sometimes we can't get it out of the ground. Sometimes we can't refine it. Sometimes we can't ship it. All these things play into the factor, right? And then you add on top of it, certain government regimes don't even want us doing it. They're appeasing to one group and we can't do this for a while. And so so what happens is diesel's supply chain is different than gasoline's supply chain. It's been more disrupted. But what happens in commodities, the cure to high prices is high prices. You'll have more market participants coming in to create more diesel and it will get fixed. It happens in every cycle, right?
That makes sense. Okay, we're done with questions. Let's keep going. That was great.
Okay, couple other things. There's been tremendous negativity. I don't want to spend too much time on this, but you just need to know that market participants have been very negative and pessimistic, which, by the way, is important because usually that is the end of a cycle and the beginning of a new cycle. The best time to buy assets, when you're talking about high quality assets, the best time to buy them is when nobody wants them. It's that simple. We can create all the noise we want, but we have people freaking out that the world is coming to an end because of whatever. You pick your concern and you see it monetarily. People are putting their money where their mouth is. This is people buying puts. It's buying insurance on investment assets. They're going to go down, right? Record numbers of that type of participation. Here's the same data in another way for those of you that know what puts and calls are. People clamoring to buy puts, which means they're very nervous. They're very scared. By the way, historically, these were the times you wanted to buy. Look at 03, market bottom. Look at 09, market bottom. Look at 16, energy crisis, market bottom. Look at 2020. I mean, it's like clockwork. That's the market bottom. So I'm not saying this is the bottom. I'm just saying we're seeing the behavior that's like a bottom, okay? This is selling of stocks. We saw a real surge at the end of the year for people to sell stocks. They were very nervous, right? Fund managers are holding a ton of cash. That's not normal. We haven't seen that for 20 years. But you know what's weird? That's the best time to invest. When fund managers are even nervous, forward returns are in the light blue, the royal blue. That's the 1-year return of the S&P 500. Well, those are some really compelling times to invest. So even if the pros are nervous, that's even more compelling. And this chart's wild. This goes back to 87. Last year was the first year in history that the weekly surveys of how investors feel, not one single week of the entire year was above average. In other words, pessimism has just been incredibly rampant, which is really ironic
and persistent. Like that's
yeah.
a long time to stay negative.
Yeah. And what's crazy about it is the economy's been excellent. Everybody gets raises. The value of your home went up. By the way, a lot of this is because of the media. We are living in a cesspool of negativity. So the average person just thinks everything is terrible when actually that's not the fundamentals at all. Okay. Zach, let me just run a couple of these and I'll be done. The fundamentals themselves of the economy. Let's go through a couple of them. This is earnings. Look, this is revised earnings down, and we still have tremendous growth in corporate earnings in this country. Here's the same data in another way. Look at how much money S&P 500 companies have made, not sold. This is not sales. This is profit. It exploded coming out of COVID. It just exploded. Of course, we need to rein that in a little bit. Otherwise, you run an economy that just blows itself up on an inflationary environment, right? We needed to cool this off a little bit. Okay, this is a lie I want to dispel because the media is constantly telling you that we have an economy that's on the edge. People are run out of money. They're using debt. It's not true. Okay, I want to show you a couple things here. This is what businesses are paying in debt costs. It is at a multi-decade low. Okay, businesses are not the government. The government is in debt heavily. Businesses are not. Okay, here's small businesses. This is every small business customer of Bank of America and how much cash they're holding. Okay, coming out of COVID, you would expect a bump because of PPP. We gave them free money. But what happened? They kept stockpiling more cash after that. Okay. Our businesses in this country are flush with cash if they survived. A lot of places didn't survive COVID, but those that did are flush with cash now, right? This is investors. This is you and me. The average American that has a brokerage account is sitting on like 25% cash. Okay, that happens at market bottoms, not market tops. That's the kind of behavior when people are very nervous. They just want to hold cash. Right? So we've seen that, again, that's very constructive, by the way, for the economy. Here's that thing you're hearing. Everyone's living on their credit cards. We've just barely made it back to where we were before. And the size of the economy has grown. So on a percentage basis, it's lower, right? Look at this. Look at the next one. Okay. This is the average household, just you and me, husbands and wives. This is how much we're spending. This is how much our debt is compared to how much we're making. Okay. We've seen a little move up. People are using a little more debt on the right side of the chart there from where we were, but we were at really multi-decade lows as homeowners in this country of the amount of debt that we were using. Here's another one. People tapping credit cards and home equity. It's barely moved. In fact, home equity hasn't even budged, right? It's really hard to get a home equity loan. Who wants to go through that paperwork? But even with credit cards, has barely budged. Okay, this is why. This is the secret, Zach. This is what no one wants to talk about. Banks are stockpiling your money. And look on the right, when you and I put money in a bank, they're only lending out about 60 cents of it. Again, you have to go back to the 1960s to find a time that banks were this conservative with their money. Okay, look at the left. How conservative are they? They will only lend to people. Okay, this is what the pools of debt look like at Bank of America, the second largest lender in the country. Look at the FICO scores. I mean, you got to have a 750 north to even dream of getting a loan of any kind from a bank right now, right? So this is the opposite of 2008. We are actually rock solid in this country in terms of cash pictures, debt pictures, the banking system, etc. And in fact, the risk is the economy is so good at the core that inflation goes back up again. And that's why the Fed is erring on the side of raising rates too high to be absolutely certain they've contained inflation. They are trying to slow the economy down, okay? Because the fundamentals, and this is what I'm showing you in the data here, is actually very, very good. Okay, couple other things. Stocks, they're not cheap, but they're not expensive anymore. They're right at the long run average, okay?
We see this chart regularly. To go back there, just so you guys know, like Kurt brings this one up every single time. And you can see the bend in the peaks of that dark navy blue line. In calls every quarter that we've had, we've been talking about, this is the price to earnings ratio. This is how expensive the stock is divided by its earnings. In other words, if this was a small business and you paid 20 times earnings, if you were taking the cash flow of the earnings back out of your small business, you would get all your money back in 20 years and still own the business, is the concept, right? And so it's this number coming down makes it so that it's a lesser time in a small business to make your money back. But generally, that's not how people look at it for large public institutions. They look at it more in terms of, is it just expensive or cheap for me to enter into these stocks at these prices? I'm gonna hit Mark's question a little bit here. Something that, if you're okay with me being as bold as to say, Kurt is one of the best people in the world just because he's always so positive on life. But Kurt sometimes is also probably more positive on average on markets as well. It's one of the great things about Kurt, right? So in general, if I take what we talk about in these sessions and compare our tone against the feeling we get from all of you, on average, this session is more positive than what we hear from all of you. That's the bottom line. Just kind of giving you guys some insight into how we feel and how that turns out. So Mark, your question says, so based upon the slides, is the economy poised to recover? I think, Kurt, if it's okay for me to say this, you're basically saying we're seeing a lot of conditions and market behavior and people's behavior that typically coincides with market bottoms. But we're not necessarily saying like, hey, things are going to be great, buy, go. It's more of like, we're looking at the data and trying to read leading economic indicators, and we're seeing that a lot of the activity that we normally see when markets are low we're just seeing that right now. And if it's okay for me to say this to all of our clients, part of the reason I think that people like Kurt and me feel like we have to be so clear and maybe even positive about markets is to somewhat combat the awful cycle that you get from every other source out there. I mean, Steve, you maybe said maybe I should stop reading the internet news, but that's the point, is part of the reason is because we want to show you data that shows, hey, it's not perfect, but there are actually some signs that we see when things are poised to do well. And it's not perfect, but corporations are sitting on a whole bunch of cash. It's not perfect. Banks are only lending to really high quality borrowers. And it's not perfect, but banks are sitting on a bunch of cash, and businesses are making a ton of money, and that couldn't go forever. And that's part of the reason it came down. Anyway, I'm hoping to help give you guys the context, but you're only experiencing, if you're not listening to someone like us, and if you're getting it from other sources, there is an intense amount of negativity right now. And I think that the instant news we pound on that too much. So maybe I just leave it there. But the point I'm trying to make, Mark, is that I think it's not a time to be crazy afraid. When I see what I see right now, it doesn't make me crazy afraid, but this is a risk tolerance thing. And generally, this is how we build portfolios, is a majority of your portfolio should not be based on what you think the macro economy is going to do, if not all. You either have all your portfolio invested at the right risk level in good quality assets you're comfortable with, whether it goes up or down, or you just take a portion of it and say, this is the portion that I'm willing to take a little bit more of a bet when things look like they will do well, and pull that risk off when things look like they will do poorly. That's it.
That's so well said. I mean, and remember, we're talking about two different things, the economy and the markets, and they're not the same. I mean, look at this chart here. If you said, I'm going to wait till the recession is over to invest, If you do that, you're 15 months late of the stock market bottoming, and you missed on average a 61% rally. And so one of the things that Zacc and I are trying to accomplish with clients is to look forward. Because if we obsess about the noise in the short term, we would never do quality investing. It's too much noise in the short term. And the other thing is the media by definition is being negative to get you to watch. And almost never is the reality as negative as what the media is saying. And by the way, I manage money, and Zacc and I manage money for hundreds of business owners. Okay. Even in the depths of COVID, the depths of the financial crisis, what do our business owners do when they wake up in the morning and the alarm goes off? They get up and they do their best to create a great product, run a great business, keep employees happy, control costs, etc. Because of that, it's always creating an opportunity to make money investing. Regardless of the noise that's happening, those people driving the economy are getting up every day with that same mission in mind. And that's why this works, right? That's why you have opportunity,
Makes sense. Okay.
Such a great point.
That's good. I'm hoping that helps with a couple of the questions in there about overall market direction. Yeah. We don't know. Nobody knows. Even the professionals we've looked at it, they don't know. They're all over the map. The general consensus is that everybody is verbally afraid of it, but they think the market's going to be positive. Yeah. So it's like, okay, that's helpful. Not really.
And there's a lot of other stuff I can show here. Maybe we should open it up for some questions while we have some time.
So let's tackle the one about national debt. So wondering how concerned you are about national debt. This is also one of those that I feel like gets hit pretty hard, and it is a problem, and it's probably a problem for future generations more so than it is for most of our clients. But how do you feel like? Well, let's answer this question two ways. Do you think that the national debt poses a problem for our typical 50, maybe 60-year-old client, and why? And then maybe expand on that then to say, okay, how does it affect their kids?
No, it doesn't. It doesn't affect us. I know this is crazy. Okay. Yeah. And you're talking to somebody who hates debt. I hate national debt. I'm not a government fan at all, any political party. I'm like, but the reality on our investments is it kind of doesn't matter. But let me tell you why. Okay. And it's the same thing in China. I can show you 1,000 news articles about Chinese debt and why it's so dangerous. But remember, what makes debt dangerous? Somebody not paying it back is what makes debt dangerous. And we all learned that in the financial crisis. Well, if the government is its own borrower, what's defaulting? Now it's different if JP Morgan doesn't pay off their bonds. That's a problem. But when the government is its own borrower, and this is what people don't understand about China, Zacc, is that they're not reconciling the books. They don't need to. And our government, frankly, doesn't need to either. Now, here's where it matters, okay? Where it matters is when no one will lend to you, okay?
Yeah.
So the best thing we have going for us is that the US dollar and US treasuries are the very, very best house in a bad neighborhood. So when the world gets upset financially, they rush to the dollar. Look what's happened since COVID to the dollar. It just goes up, 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 right? Look at treasuries, right? Like that's where the world runs to. So with all of our dysfunction, there is zero chance that the dollar's being replaced as a reserve currency. I'm sick of hearing it. I've been hearing it for 30 years in my career, okay? What are you gonna buy? Even the Chinese, you talk to Chinese billionaires, where are they trying to put their money? The US is where they're trying to get their money. I sit on the board of a financial services company in China. They want their money here. Like, okay, what are you going to buy? You're going to go to Great Britain? You're going to go to Japan? These are dumpster fires. The United States, and we have a lot of dysfunction and a lot of problems. That's why I'm not worried about it. And I hate it. We shouldn't be going into debt like this. It's totally irresponsible.
So wait, let me see if I can, because I want to make sure I'm following and translating sometimes too, but like you're saying the reason, so we don't love debt. We'd love to not take on as much debt. We'd love to have the deficit not be what it is. But the reason that it's been okay is because the likelihood of the United States paying it back is so incredibly high, because we are the reserve currency. We can tax whatever we want and we can print whatever we want. And so the governing bodies that don't have those three pieces in place, where reserve currency, tax whatever you want, and print whatever you want, make it so that they are at a higher risk of taking on national debt. And that's why it matters that those three things still remain in the US. And I guess what I'm hearing is that your opinion is that those three things will likely continue to remain the way they are in the US for most of our lifetimes.
In the last 30 years, the national debt's gone up by, okay, name your number. I haven't pulled it up. It's astronomical. Okay. How much has that impacted Apple Computer's profits?
It really hasn't. In fact, they've done great.
Zero. There's no impact whatsoever. Now, here's the problem. If you're Venezuela or Argentina, who's going to loan you money? Nobody. If you're the United States, people are coming. And so what I'm saying is, I don't like it, but it's actually not posing any risk because we're the United States. If you and me were sitting in Brazil right now, I would feel very differently about that question.
Right. They're not the reserve currency.
They're not.
And they could print or they could tax, but those things don't work when nobody's willing to lend to you.
That's right. And by the way, I'm saying we should vote for our legislators to run a more balanced budget. That's what I think. But the reality is, this is not going to impact our economy or corporate earnings at all. None.
Right.
I don't like it. It's like taxes. Here's something crazy. There's no correlation between the economy and tax rates in the United States. Okay, so I want lower taxes. That's what I want. But the truth of the matter is we've had governments that have jacked up tax rates and the economy has thrived. And we've had governments that have lower tax rates and the economy stalled. So there's almost no correlation, but doesn't mean we still shouldn't argue about it. I'm just saying the reality of your portfolio, it doesn't matter.
Got it. Okay, a couple questions, and then we'll probably just talk about like your working thesis here. What generally lasts longer, inflation or recession?
Oh,
or is it a wash?
Inflation's way more rare. So recessions are really normal and less scary. The reason you guys are noticing so much concern about inflation, number one, it's rare. And number two, it's dangerous. When the economy goes into a recession, we can stimulate our way out of it. We can cut taxes. We can there's all kinds of things we can do to get an economy going. Man, when you're running too hot, you don't have a lot of levers to pull. When everyone's at the drunken party, how do you slow that down? We don't have as many tools to slow it down. That's why you're noticing, by the way, the Fed has all this data and more, and they're saying, nope, we're going to raise rates more because they're going to err on the side of slowing inflation down because they can always stimulate the recession later.
Well, it feels like they have tools. They're just so painful that they're political suicide at times.
That's right.
So they're tools that just nobody wants to feel and nobody wants to use.
Yep, they're nuclear.
Yeah, that makes sense.
Yeah.
So, but then you're saying that recessions probably, so to be specific to his question, come and go a little bit. Well, and by the way, it feels like, Steve, that the window of that, not just feels like, it is, the window of recessions has shortened as the federal government, the Fed, have actually taken a more active role in markets. So it used to be that this is before my time even in the industry, it used to be they let, not on purpose, but they didn't have the tools, and they would let the recessions work them way out. They were trying their darndest, but it didn't really work. Now they have, with financial markets becoming more sophisticated and data becoming more available, part of the reason that it's so hard to anticipate what's going on is the window of data to action is now so short that it's shortened these cycles of recession recovery, and it's hard to even know what's happening at the moment sometimes.
That you're exactly, that there are so many tools to reinvigorate economy. Let me tell you a serious conversation that's been happening for several years in Washington. Think about this for a minute. If you don't need to run a balanced budget and you're not really scared of government debt because it's just borrowing it from itself, it's just a journaling on a piece of paper, and they just print some money and buy something and go into debt. Okay, why do we need taxes?
Well,
I mean,
to control incentives, that's what's going on there.
If the government wants to build an airport or a road, and they can just say, you know what, we're going to borrow from ourselves, build an airport. Why do they need my tax money? And I'm bringing that up seriously because it's being workshopped for a couple of decades that one of the ways to stimulate the economy is to temporarily just say, no taxes this year for anybody.
Wow.
Bang. You think about what would happen, but it's really hard to go the other direction and slow things down, you know.
That makes sense. Okay, so let's talk about bonds for a second. So, and Kevin, good questions about deficit, taxes, debt, and probably we're talking offline a little bit here on that. Let's move on to the question about bonds. So how should we handle bond positions? And by the way, you know, Kurt has a whole team of fixed income traders. So Monica and Josh are some of the best to be able to handle these questions, but we'll take a stab at it. And how would you handle bond positions over the next several years? And what are your thoughts about bond allocations right now? I'm going to throw a couple of thoughts out just so that everybody knows. And then Kurt, you fill in. Okay, so it depends on your purchase time. Owning bonds in the last little while has been rough because interest rates have gone up. And as interest rates go up, if you have a bond that pays 2% and there's an identical one out there that now pays 5%, your bond isn't worth as much as the one that pays 5%. So on the secondary market, it's going to be discounted a little bit to reflect a 5% total return. And so that means your price is going to come down a little bit. That's the frustrating aspect of owning bonds. And that's what they call interest rate risk. So you are subject to interest rate risk, which is different than the risk you have in stocks. Different risks provide lower volatility overall. So owning bonds is a good thing in portfolios for those who have money tied to specific timeframes, which is a lot of our clients because they're thinking about retirement, right? So here's the thing. Right now, bonds are pretty attractive, especially if you're targeting specific goals. And our bond traders can buy portfolios where we're targeting. I have one client that we're looking to put quite a bit for taxes next year, or sorry, taxes this year in April. And until recently, we would just say, just leave it in your bank. We can't get anything for you on 1 to 6 month bonds of any type. And now we're seeing that if you have enough money, which there are some minimums there, but you can actually buy individual bonds that pay quite well for under 1 and 2 years. So I think that there's a lot of advantage in using excess cash, buying high quality fixed income instruments that pay better rates than what you would get in just sitting in your savings accounts. Then on top of that, when it comes to broad bond allocations, if you can try to target that to your time frame, that's great. There's 2 reasons to own bonds: because you want it to mature at a certain time, or you want to diversify risk. And a lot of what we do is diversify risk and have something perform differently than stocks. And then we automatically are rebalancing between them. So the part of your question, like, how do you handle it? Well, if we manage your money, then part of that's handled all on its own. We're rebalancing back and forth between stocks and bonds periodically throughout the year. When things drop drastically, we're doing a very manual and conscious effort, and we're going to Townsquare and saying, hey, let's do it right now. Take this much of the assets that haven't gone down, buy into these cheaper stocks. But anyway, that hopefully gives you a little bit of a rough idea. I really like the concept right now. There have been so many people that have come to us. I've got $400,000 in cash. I've got $500,000 in cash. I don't know what to do with it. And it's been frustrating because I'll ask them, well, when do you need it again? And they'll say, within this time frame. And I'll usually say, I can't do anything that great for you within that short little window. And we're finally seeing some decent rates to be able to do some pretty interesting things, which is good. Anyway, Kurt, what else would you add to that?
No, that is perfect. What I would emphasize out of that is there are multiple uses for owning bonds. There's the cash flow that comes from owning the bonds, and that varies from time to time. But then there's just the owning the bonds because it's typically a more stable type of holding place, right, in a portfolio. There are times where even if you're only getting 1% on your bonds, it's still compelling to own some bonds, right? Because you might have the stock market drop a lot. Last year was hard because we went through a period where bonds went up for 30 years straight. And then we finally had a big drop in bond prices, making interest rates go back up. But if the quality of your bonds are good, you don't own a bunch of garbage and crap and junk and, then you're going to be just fine. You got to be patient a little bit on the pricing as prices of those bonds normalize. And as you get closer to bonds maturing, they go back to flat. They go back to 100 or par, we call it, right? So
as you
go
ahead, sorry.
No, go ahead.
But as you have a shorter, they call it duration, or maturity is related to duration. We're not going to explain that today, but as you have a shorter time period on those bonds, they typically experience less volatility, because the idea is you're about to get your whole deposit back shortly. So the risk of having to be stuck at a certain rate for a long period of time is less, or is lower, I should say, because you're in a shorter time frame until you get your money back. So there's think of it like a fixed point, and then you've got this rope that's whipping out like in the distance, the shorter the time horizon. So shorter time horizons and higher quality typically provide you with less volatility. And that's what we've been trying to do for the last several years, because bond rates have been so low. And we've tried not to, I'll tell you right now, it's been frustrating for the last 5 years because people haven't made that much interest on their bonds. But in our portfolios, we've tried to keep a fairly short to midterm duration. So that means that you all didn't experience as much loss as a lot of investors in the last 6 months, because we didn't stretch like crazy for yield. In other words, the reason for your bonds in your portfolios has generally been stability rather than high yield. And that has been helpful in a downturn, if that helps.
Hey, can I emphasize one thing? You touched on it briefly, but let me say it more clear. The chart on the right shows you that the banks don't want your money right now. So if you are listening to this call and you are sitting on a fair amount of cash, okay, you can actually go out into the bond market and buy very safe short-term bonds right now and get a lot more money than the bank is paying you, because the bank is not incentivized to get more cash in the door right now. It's an anomaly. It's only happened a couple times in 100 years. So if you're sitting on a lot of cash, call someone on the team, Zacc or your advisor, because we actually can directly go out and buy government bonds for you, cut the bank out of the middle, and get you another 1 or 2 or 3% interest on that cash while you're holding it. So I really want to emphasize that, because it's very rare that this happens. And it's because the banks are being so conservative. They don't need any more cash. They're sitting on trillions of cash right now as it is.
Makes sense.
Hey,
well,
Zacc,
we're 2 minutes to the end. Anything you want to add before we wrap up?
I want to do this one thing. Crypto, been under a lot of stress, gets a lot of media attention. I've been asked many times in the last 4 months, if the crypto market evaporates and gets even worse from here. We say, I'm not saying we will. I'm just saying it's been bad. If it gets really bad, is that going to bring down the financial system with it? I wanted to put this into perspective for your viewers. As of the end of November, and it hasn't really moved much since then, the value of every single crypto coin is only $870 billion. Okay, in the whole world. That's the same as the market capitalization or the size of Johnny John and United Healthcare. Okay, so granted, if Johnson & Johnson and United Healthcare went bankrupt, it would suck, but that's not going to bring down the financial system. Okay, that's the perspective on the size of the crypto market. So you're going to hear the media obsess about it. If crypto comes under stress again, it is not going to take down our financial system. I just thought I'd clarify that, Zacc, because I've gotten that question a lot.
Yeah, that's really good. And you gave some good feedback on that back when it was really, really hot. And you said, the government's going to get a pound of flesh out of that. And I don't trust it a whole lot. And anyway, that aged pretty well. That was good. Okay, well, I think there are a few questions in there. We tried to hit as many of them as we could. We're wrapping up here. We really appreciate you all joining us. I'll put I'll just throw another screen up really quick, just in case anybody doesn't have contact info, but know that we're happy to have you call us. We're happy to walk through it. Happy to help you in anything we can.
All right. Take care, man.
Yeah, we'll talk to you later. Bye.
Have a good one, everybody.